Welcome to Accounting with Professor Lamptey. In the last video, we talked about cash basis and accrual basis accounting. That lesson is very important because it prepares us for today's topic, adjusting entries. We learned one important idea. Cash basis records transactions when cash moves, but accrual basis records revenues when earned and expenses when incurred. That difference is the foundation for adjusting entries. Once you understand accrual accounting, adjusting entries begin to make sense. Why? Because accrual accounting is not only asking whether cash moved, it is asking whether revenue has been earned and whether an expense has been incurred. Now, I know what some students are thinking. Professor Lamptey, I was just getting comfortable with journal entries. Now you are telling me there are adjusting entries too? Yes. Accounting has layers. It is like cooking jollof rice. You do not just throw rice in a pot and hope for the best. You need timing, seasoning, heat, and patience. In the same way, accounting needs timing, measurement, and adjustments before the financial statements are ready. So here's the simple idea for today. Adjusting entries are made at the end of the accounting period to update accounts before financial statements are prepared. They help make sure revenues and expenses are recorded in the correct period. During the accounting period, businesses record many transactions. They record sales, purchases, cash receipts, cash payments, and journal entries. Those entries are posted to the ledger, but by the end of the period, some balances may still need to be updated. This does not always mean someone made a mistake. Sometimes the accounts simply need updating because time has passed. Sometimes an event has happened, but the accounting record has not caught up yet. For example, employees may have worked, but they have not yet been paid. A business may have used insurance coverage that was paid for earlier. A company may have earned revenue, but the customer has not yet been billed. Equipment may have been used during the period and lost some value. These situations require adjusting entries. Adjusting entries are not there to scare students. They are there to help the accounts tell the truth. Without them, financial statements may be incomplete or misleading. We do not want financial statements that look good but tell the wrong story. That is like a student who says, "I studied all night, but the textbook is still in the plastic wrap." The story and the evidence must match. Adjusting entries matter because financial statements must report the correct amounts for the correct period. Under accrual accounting, revenue is recorded when earned. Expenses are recorded when incurred, not necessarily when cash is received or paid. Adjusting entries help us answer important questions. Has revenue been earned but not yet recorded? Has an expense been incurred but not yet recorded? Has an asset been used up? Has a liability been reduced because service has now been provided? Adjusting entries are usually made at the end of the accounting period. In the accounting cycle, they come after the unadjusted trial balance and before the adjusted trial balance and financial statements. So adjusting entries are a bridge between normal recording and accurate reporting. In introductory accounting, we usually focus on 5 main types of adjusting entries: prepaid expenses, unearned revenues, accrued expenses, accrued revenues, and depreciation. Do not worry, we will take them one at a time. A prepaid expense happens when a business pays cash before using a service or benefit. Examples include insurance paid in advance, rent paid in advance, and supplies purchased before use. At first, the business records an asset because it is paid for something that will benefit the future. But as time passes, that benefit is used up. Let's use insurance. Assume a business pays $12,000 on January 1st for 1 year of insurance. At the time of payment, the business records prepaid insurance because the insurance has not been used yet. Now 1 month passes. $12,000 divided by 12 months equals $1,000 per month. So the adjusting entry is debit insurance expense, $1,000, and credit prepaid insurance, $1,000. This means the asset decreases and the expense increases. Unearned revenue happens when a business receives cash before it provides goods or services. This is common. A customer pays in advance. A tenant pays rent before the rental period is over. A client pays before the work is completed. At the time cash is received, the business records a liability because it still owes the customer goods or services. Assume a business receives $3,000 on January 1st for services to be provided over 3 months. At first, the business records cash and unearned revenue. Now 1 month passes. By the end of January, 1 month of service has been provided. $3,000 divided by 3 months equals $1,000 per month. The adjusting entry is debit unearned revenue, $1,000, and credit service revenue, $1,000. The liability decreases and revenue increases. An accrued expense happens when a business has incurred an expense but has not yet paid cash or recorded the expense. Examples include wages earned by employees but not yet paid, interest incurred but not yet paid, and utilities used but not yet billed. The key point is simple. The expense happened before the cash was paid. Assume employees worked during the last week of December and earned $2,000, but the company will not pay them until January. Should the company ignore the wages in December because cash has not been paid? No. Under accrual accounting, expenses are recorded when incurred. The employees worked in December, so the wage expense belongs in December. The adjusting entry is debit wages expense, $2,000, and credit wages payable, $2,000. Accrued revenue happens when a business has earned revenue but has not yet received cash or recorded the revenue. Examples include services provided but not yet billed, interest earned but not yet received, and rent earned but not yet collected. The work is done, the cash has not arrived yet, but the revenue has been earned. Assume a business provides services worth $1,500 in December, but it will not bill the customer until January. Has the business earned the revenue in December? Yes. The service was provided in December, so the revenue belongs in December. The adjusting entry is debit accounts receivable, $1,500, and credit service revenue, $1,500. The asset increases and revenue increases. Now let's talk about depreciation. Depreciation is the process of allocating the cost of a long-term asset over its useful life. Examples include equipment, buildings, vehicles, furniture, and computers. Assume a business buys equipment for $10,000 and expects to use it for 5 years. Using straight-line depreciation, the business records $2,000 of depreciation expense each year. The adjusting entry is debit depreciation expense, $2,000, and credit accumulated depreciation, $2,000. We credit accumulated depreciation instead of crediting equipment directly. Now let's notice the pattern. Most adjusting entries affect one income statement account and one balance sheet account. For example, insurance expense and prepaid insurance, service revenue and unearned revenue, wages expense and wages payable, accounts receivable and service revenue, depreciation expense and accumulated depreciation. Let's also avoid common mistakes. Most adjusting entries do not involve cash. Prepaid expense means cash was paid before the expense was used. Accrued expense means the expense happened before cash was paid. Unearned revenue means cash was received before revenue was earned. Accrued revenue means revenue was earned before cash was received. So here is the final recap. Adjusting entries are made at the end of the accounting period before financial statements are prepared. They update account balances so revenues and expenses are recorded in the correct period. The 5 major types are prepaid expenses, unearned revenues, accrued expenses, accrued revenues, and depreciation. And remember this, adjusting entries are the bridge between daily transactions and accurate financial statements. Thank you for watching Accounting with Professor Lamptey. Learn accounting, think critically, make better decisions. I will see you in the next video.